You're now listening to Cashed In.
Okay, so we're here today. It's episode 7 of Cashed In. And statistically speaking, most podcasts fail after episode 7. So we've reached a huge milestone. Congrats to us at Cashed In. Today, specifically, we want to talk about something that I find super interesting and that I've been breaking into as a real estate agent. I have been helping my clients do what's called a 1031 exchange, which is completely legal, and it is a tax deferment strategy. And it's when you defer what's called capital gains on a gain that you have from, usually it's from selling real estate. So you have a gain, and there's different methods and strategies to defer being taxed at your current tax rate. And that's taking that gain and putting it into something else. So we want to talk about that today. So, Michael, I'll let you start it off.
Yeah, so this is a fascinating it's a fascinating strategy, if you want to call it that.
Yeah.
I know that oftentimes people call it swap till you drop.
Okay.
Yeah,
basically.
Yeah, so you really, what you're doing is just what you said. You're deferring your taxes, your capital gains, till you drop.
Till you're dead.
Till you're dead. You can do that.
Yep.
And
your heirs don't pay on it.
Yeah, right. So because once you die, your taxes die. Your taxable obligation dies with you.
Thank God.
Right. So I've been fascinated by this. I came kind of at a crossroads last fall. I had sold a property that I'd been holding for about 5 years. I was using it as a short-term rental in Ocean City, Maryland. And I was going through this process. I ultimately decided that it wasn't in the best interest of myself to go through this process. But I really went through the process without actually doing it.
Yeah.
So basically, what you're doing here with the 1031 is, okay, I'm going to sell a property. It's an investment property. And quite frankly, it doesn't have to necessarily be real estate. You could do it with businesses. People have done this, with different avenues as it relates to the IRS code. But nonetheless, essentially what you're doing is, okay, I'm going to sell a property. Then once I close on the property, I then have 45 days in which I have to designate or I have to think about a property that I would buy within that time frame. So now I have 3 properties, and you're going to have an intermediary, if you would.
Yeah, you can't touch the gain. You can't touch the money.
Right, so you can't touch the money. So you're going to close. It's a great point. So you're going to close. Instead of getting a check at close, that money is now going to go to the intermediary. They're going to hold on to that fund. So if you have $100,000, they're holding $100,000.
Yeah, you designate who the intermediary is before closing. And that intermediary can be First American Title. That's who I've been recommended or been recommending out. It's a non-interest bearing escrow account where your money goes. So you have an agreement beforehand. You close, the money goes into that escrow account.
Right. Yeah. So they're going to be holding that. Then you have 45 days that you have to pick a property. Right.
Yeah.
You have to pick up the 3 properties. There has to be documentation that you had informed the intermediary of which 3 properties there are. Mm-hmm. Okay. And then you have 180 days, not beyond that point, but 180 days from closing to then close on another deal or deals with a like kind property.
Yes.
So for example, if you sold land that's undeveloped, then you have to be buying
land that's undeveloped. Yeah.
Right. So it has to be
buying
like
a trailer park because that's not the same.
It's correct. So it has to be a like kind asset in the eyes of the IRS. So there's so many different. I don't want to go in the weeds with this like we had talked about before.
Yeah, because I'm not a CPA. I'm not a tax expert by any means. It's just what what I'm seeing and what you're seeing on how to avoid being taxed at like a 35 or 40% tax rate and getting nothing out of it. Mm-hmm. It's advantageous because, for example, okay, I had a closing last week. My guy flipped a property, and he made $100,000 in a gain. Mm-hmm. And I asked him, his name was Brian. I was like, Brian, what are you doing with these what are you doing with your check? What are you doing with these capital gains? But it was too late. It was already written out to his personal name, and he cashed it. I'm like, you're going to be taxed on that capital gain, that 35%. So you might as well just take $35,000 you just made on that $100,000 and burn it outside.
Right.
Because what are you getting for it? And because he's going to flip multiple properties, I was like, why don't you give it to an intermediary and, you're going to buy another property anyway. why don't you put that gain into that intermediary account and we could go shopping for another one?
Mm-hmm.
And then, so we just looked it up. I mean, the average cost for an intermediary holding, at least what we saw on Google really quick, was like $1,200.
Right.
That's way cheaper than $30,000.
That's right.
So,
In the worst case scenario too, say for example, you don't find a property, right? That was ultimately why I didn't do it. Is I didn't end up doing the 1031 with Ocean City when I sold it, was because I was worried that in this market, in the environment that we're at, that I was going to chase after a property that ultimately wasn't worth it based on the price point, and I was just going to be buying something for the sake of buying something within that timeline.
yeah.
Now, in the grand scheme of things, when I look back, when I've learned more about the code, if I don't find something, I don't buy something within 180 days, I could take that money back and I'm just taxed on it.
Write it off.
Well, yeah, I'm just taxed on. You're just taxed
you're talking
on
about
it
the gain.
at the gain,
Okay.
right? So
I thought you
that
were talking about
$100
the
grand,
cost, yeah.
I would just end up ultimately paying the capital gains on that.
Anyway, but at least you
Anyways.
gave yourself a fair
You
shot
do
to try
that,
to avoid
right?
it.
You know, and
Yeah.
in hindsight, you know, I would consider that. I mean, I had different losses and stuff like that I was able to take into account prior to making that decision. But ultimately, I think that it's all planning.
It is.
You have to be
Yeah.
able to plan. Like if you're going to sell a property, you need to know, okay, what am I going to be doing with the proceeds from this? Am I going to reinvest it? Am I going to defer it? And then
Yeah.
am I going to keep on with that approach?
Yeah.
Or am I going to sit there and say, you know what, like I did this. I'm probably not going to do another one. I don't have time to do another flip.
Mhm.
I don't want to go through another rehab or a process and buy another investment property. I'm just going to ultimately, you know, pay the capital gains on it and be done.
Mhm.
Now there's different strategies, which is unique. And I think that I will touch the surface of it just because I want viewers to understand the scope in which real estate is favorable to growing wealth and to your overall tax situation.
Yeah.
In terms of your strategy. Some people, now I believe they closed the loophole. You were actually able to buy an investment property, okay, rehab it, do what you would, flip it, sell it. Then what some people would actually do is they would use that 1031, they would defer the taxes, go through the whole process, buy another, let's say another single family home.
Mhm.
They would then live in it, okay, for outwards of a couple years. I think the minimum is to live in it. They would call it their primary residence, and then you're not taxed on it because it was your primary residence for 2 years. So now the taxable obligation there is gone from the previous.
That's
from the
right,
previous
because
property.
this is only on investment properties. And I remember exactly where I was, where you and I had a phone conversation because you were selling Iroquois. And I was like, wait, you're talking about capital gains.
We're talking about,
and I was like,
correct.
oh, you're safe up to $250,000 in a gain.
Yeah,
But that was
I think it's
because it was
500,
on
yeah.
what's $500,000 for
married,
if you're
for
married,
yeah.
$250,000 if you're single, and that's only on a primary.
Mm-hmm.
And what we're talking about is obviously for investment. So that's interesting. Is the loophole closed?
I have to check. I think that it is. I want to say that it is because what people were doing were they would do this and then they would go and they would buy they'd buy like a vacation property.
Yeah.
You know, they would say that it's their primary residence or whatever, and
Mhm.
you know they had zero intent of investing it. But you know, you could say that your intent, just like with second home financing. quite
Yeah,
frankly,
that's
now
what that's
still
what
changed.
right
Your
is in
intent
my head.
is that I'm going to use it as a second home,
Yeah,
not as a full-time investment property on Airbnb.
it just happens to be that
It just,
way.
I had to change a heart
I don't know.
after closing. So it's
People
fascinating
screw
that you
in
could do that. And then
Yeah,
it's also, we had talked about beforehand, just about kind of reverse engineering it.
yeah,
The law allows you to do it in reverse.
and that's current. That what we were talking about prior to this episode. Go into what you were explaining to me about a reverse 1031.
Mm-hmm. Yeah, so you could actually buy a property, okay? And again, this goes into that whole planning aspect of it. So for example, if I know that I want to defer taxes and I know that I'm in this for the long haul, okay? And I am worried about being able to identify a property in this market because the reality is I could identify 3 properties and tell the intermediary about all 3 of them. All 3 of them can be gone.
Yeah,
Somebody
or
can
off
scoop
market.
them up and they're gone. Now I'm in a spot where it's a time crunch because I could be 45 days down the line, okay, and have identified 3 properties. Now I have an additional 135 days to close.
Mm-hmm.
So now you're in a position where it's like, okay, now I'm scrambling to sit there and find this. So the reverse way would be that I'm gonna buy a quadplex. I'm gonna buy a 4-unit property with the idea that I'm going to, by the time I close on that, I'm going to then list another property that I planned on selling. I'm going to unload another property, similar price point. I know what the taxable obligation is. It becomes a big equation at that point. And then ultimately what you're going to do is you'd hope that it would close within 180 days from that time period. And it's the same thing.
Yeah.
Now that taxable obligation is deferred on that purchase or on that sale. So
I see.
it can get kind of complex. I'm trying to stay as high level as possible with it, but it's important to know that the code is in favor of investors.
Yeah, just go read it. It's on like irs.gov or something.
Yeah, so
right there.
They're going to change it. I mean, the current administration, there's talks of changing 1031s and putting caps on, what the
I remember you
the capital
mentioning
gains
that.
is. And quite frankly, truthfully, I'm not a fan of doing that because there's big investors that are ultimately we're talking millions of dollars that they're doing this,
Like
but this
Blackstone.
they're doing this and they're I think that they want to cap it at 500,000, but the reality is that you have these big investors that are doing this, and say you have a 500 unit apartment building in New York City that they're doing this with, and they're now going on to the next. Look, these people are developing property in the city limits of these
Real estate's 25% of the economy anyway.
So
let it boom. Everything else is positively affected.
If they do that, mark my word, it's going to be damaging to the economy because, it's going to disincentivize people from wanting to develop these areas.
Yeah.
And I think that for small time investors like you and I, I think that it's not going to defer. I'm still doing it regardless, but it changes the way I do things.
Yeah, absolutely.
I'm just going to do a cash out on everything and hold everything. And, quite frankly, they're not getting their money until,
Yeah, exactly. So from a real estate agent standpoint, it can be lucrative. It keeps me busy, right? Because as soon as I have a client who needs to sell something, I have that side, right? The selling side, if it's in my state that I'm licensed. And I have a guaranteed sale within 180 days. So to acquire those types of clients is awesome. So I've been, from that standpoint, I've been working with
2 for 1. At least.
It's fantastic.
Yeah.
I've been working with a hedge fund buyer, and so that's corporate money. So they have to spend like $10 million a quarter. And with that, they have capital gain, or they're trying to defer some capital gains, right?
Sure.
So they have a huge portfolio in Buffalo. And they're breaking off a piece right now, 100 or 1.5 million, taking 1.5, and they're like, we need to reinvest it somewhere. They're like, we want to put it into the Florida market. They want to buy and hold, but it has to be of, like kind or greater value. Right. So they're going to take 1.5, they're going to finance the rest of it and put it into at least a $6 million, apartment building. They're leaning on me. Luckily, I'm licensed in Florida, not New York, which is where the money's coming from. But they're liquidating 1.5 in New York, and they're transferring the rest to a place in Florida. Right. They're like, wherever. Like, where do you think? Of course, I'm like, Tampa, Destin. They're like, we're thinking Jacksonville. Do you go there? And I'm like, for $6 million in volume, I will drive to Jacksonville.
It's actually, I was just talking, I have a cousin of mine in Jacksonville. That's a booming. Everything's booming right now, but that's doing really well.
Really, we'll have to talk about that. Yeah. Why is that? I wonder.
He was talking to me about it briefly. He actually sent me a couple contacts down there, but I don't know enough about it to really. But I know that it's doing well. I mean, I never understood it from a Florida perspective why Jacksonville seems like it lags everything. But you made a good point though. You had talked about how they want to redeploy the funds to a higher value asset.
Yes.
And that's quite frankly the way that I was originally taught before I really dug into it and was putting it in motion is that this is how you're going to be able to upgrade your portfolio.
Oh, exactly.
And so say for example, for math purposes, you have $100,000 in capital gains and you're going to buy a property and ultimately it's going to be, you didn't use that entire 100,000. Okay. Say you used half of it. Well, now you're going to have to buy another property that you identified within that time frame, or you're going to be taxed on that other 50,000. It gets really like
it can get intricate.
It could get really So then if you don't, then you're taxed on that 50,000. Then you take they recapture the depreciation you took on that property, and they're going to tax you at your income on that.
Sounds like a nightmare.
Well, yeah. So like you're paying capital gains on the 50. at your tax. It
Yeah.
depends on how long you held it, but at your tax bracket, either short or long term,
Mhm.
probably 20%. Then if you held that property for 5 years and you took depreciation on it, you're going to be paying 24% on the 50 grand in depreciation you took. I mean, it could really get into that. So that's
Oh my
why
God,
that's
I'm
why
so upset. This
that's
makes me
why it's
so
such a
upset.
big deal.
It is. It's a
The
huge
loophole's
deal.
there.
Yeah.
It's not a I don't even. It's not even a loophole.
It's not a
just
loophole. It's like it's a secret. It's public knowledge. It's
Yeah.
it's just another thing that you're not taught in high school on what to look for, which is taxes.
yeah.
What I wanted to bring up is you said breaking up. If the whole gain is 100 grand and you maybe put 50,000 into real estate where it makes sense, and then you have that 50,000 left over. Random, but I had a meeting 2 weeks ago with someone you and I went to high school with, and he's a financial guy, and he was telling me that you could put it into annuities.
Yeah, you could do it. You could do it into that. You could actually put it into REITs.
Yeah.
So if you want to put it into a real estate trust, essentially, I mean, you're going to have exposure into into that, and I consider doing that as well.
Mm-hmm.
But that's not
That's out of
not
my
my cup. Well, it's
out of
just
my
not my
realm.
cup of tea either.
Yeah.
I mean, I'm going to sit there and I'm going to watch this. I'm going to watch it in a volatile market fluctuate,
Yeah.
with the indexes, and it's not for me. I'd rather sit there and deploy it. I'd rather chase a property, quite frankly, than
Yeah.
put it into that.
Yeah, obviously that's against my religion, but
Yeah.
it was like a piece of
Literally, yeah. That's
knowledge that was dropped on me, and I thought, oh, okay, at least it'll be like a talking point. I was like, if you don't want to put it all here, you can put it into something else. So I didn't know that you could break it up.
Yeah, you definitely can. And that's where I think it is ultimately part of planning. Ideally, if you have $100,000, you would like to buy, if you're selling a 3-unit, instead of buying 2 more 3 units, which you could, and you have a sizable gain, why not buy a 10, 12 unit property?
Exactly.
If you can,
That's my hedge fund guy strategy.
It's all planning.
Yeah, it's have a plan. So basically, I guess to recap real quick, if if it's not a primary residence, we're talking about investment properties only. You have to plan out, find an intermediary, shop around, see what the rates are, what the charges are on this intermediary to hold your money, and to see how you access it. What's the agreement? What's their term? Things like that. And then usually when people are doing exchanges, they have everything lined up already.
You have to.
Yeah.
It's critical.
What-
Or it's 180 days blows by.
Oh my God.
Yeah, you're
So
6 months down the
fast.
line. It's
Before they even initiate the sale. That's what he's a shark. He's out there in Vegas, and all he does is 1031 exchanges on a very high level.
yeah.
He's always deferring gains on at least $1 million. These are people who sell plazas.
Yeah.
And they put them into same thing. It's
Yeah.
like, and he has both of them lined up.
Yeah.
So he's definitely taking advantage of this awesome market right now. But
Especially if you're able to get, that's another
It's
way to
off-
do it.
he does
I mean, if
everything-
you're doing off market. Is that what you're
everything's off market with
Yeah.
him. He just is
Because
basically
then
like, pay me this.
now you're not sitting there shopping around the MLS saying, oh my gosh,
or
that
competition.
went,
Yeah.
that went.
Yep.
But based on, if you have something that you tell me as another
Mhm.
investor, hey, I'm going to be unloading this. And I said, well, I'm unloading this too. How about I'm going to buy this from you. So now you have that property lined up that when you close.
Yeah, and it
Wow.
has to do with people in different stages of their investing career. So if, say you're ready to retire, you've been in real estate, you've had a property for 26 years. You've already taken advantage of that depreciation schedule, right?
Yeah.
So you're going to liquidate it on year 27. Okay, and I got to get rid of this to avoid, so I don't have to recapture my depreciation.
Yeah.
Perfect. Okay. Well, I have Michael over here who's in, the middle stages of his investment career, and he has a gain on something and he wants to defer it into your property that you're selling. So that's where it works as like an agent, where I know like 2 of my investors on different spectrums of the game. One's kind of getting out of it, one's like building. That's where it
Yeah.
works.
Right. That comes down to networking there.
I love networking.
Yeah.
That's why I'm all over the country doing it.
Yeah.
So
Right.
right. Yeah, so as you were saying, without getting too far into the weeds with it, we'll close it up here. I mean, that's pretty much the basic 101 things to know about capital gains. Do your own research. Reach out to tax lawyers and intermediaries and get actual, educated advice for your situation is what I would recommend.
For sure. And if anyone has any specific, circumstance that they're in, or they're thinking about doing, you're thinking about doing, a flip and you're wondering how that process works, feel free to message us.
Yeah, absolutely.
Cashed in at cashed_in.
Yes.
Any questions that you might have around that. But again, I think just reiterating, have a plan before you're doing this. Don't get in a position where you're chasing after selling the property, and then you're faced with, you make a nice gain on it. Now you're faced with at least a 20%, capital gains on it.
Right. So, okay. See you guys next episode 8.